Welcome, my friends. If you follow this channel, you already know that US home prices are in the midst of a major correction. There seems to be some debate over whether this is just a correction or is it a collapse. But, to me, it looks more like a slow-motion train wreck in which prices keep slowly trending downward for a long time. Home prices have already declined somewhat. But prices continue to fall and nobody really knows where they will bottom out. The Federal Reserve has been aggressively raising interest rates. And that increases mortgage rates and decreases affordability of houses. So unless potential home buyers suddenly start earning a lot more money, home prices will gradually get out of reach, financially speaking. But this trend is not coming to an end. The Federal Reserve is continuing to signal that more interest rate hikes are coming. And once interest rates are set to their targeted higher level, they will likely stay in place. So it looks as though the changes in mortgage rates and home affordability are at least temporarily permanent. Not all areas are equally affected. But pandemic-era boomtowns and cities that attracted speculators are going to be particularly hard hit. Home builder confidence is collapsing. Zillow, Redfin, and Opendoor and other iBuyers are selling off their real estate portfolios as fast as they can. Prospective buyers are backing away from the market because they think prices have a lot further to fall. What does this mean for the real estate industry? What does this mean for the future of the economy? And, what does it mean for the future of the United States? But, before we get into that, please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. The housing market crash continues on and does not seem to be ending. In fact, it looks as though home prices will be continuing their steep decline for at least the next year. This month, existing home sales declined for the 8th month in a row. Now, existing home sales is something of a composite number and can be misleading. Existing home sales is the total dollar amount of homes that were sold. That means adding up all of the values of the homes that were sold in a particular period of time. So, the existing home sales index could decline if fewer houses were sold or if the houses sold were lower priced. But normally, it means a little of both and that house prices are in decline. Rising prices tend to trigger more sales because sellers are more willing to sell if they can get a higher price. And buyers tend to be more willing to buy if they think that house prices may be increasing. As things stand right now, the existing home sales index is at its lowest level since 2007. 8 straight declines in sales and no floor in sight, Pantheon chief economist Ian Shepherdson wrote in a note on Thursday. The cumulative fall in sales from the peak in January is now 27%, Shepherdson added. But this is not the floor, Shepherdson also noted. Mortgage rates have climbed to nearly 7%, which has dampened borrowing demand, he continued. And the result will be a continued decline in home sales until early 2023, Shepherdson also noted. By that point, sales will have fallen to the incompressible minimum level, Shepherdson added. And that is the level where the only people moving home are those with no choice due to job or family circumstances, he predicted. Discretionary buyers are disappearing rapidly in the face of the near 400 basis point increase in rates over the past year, Shepherdson continued. In other words, the only homeowners who are willing to sell are the ones who are basically forced to sell by confluence of circumstances. By now, prices for existing homes have been in declining sequentially for the past 3 months. As things stand right now, the median price of a single-family house in the U.S. is now $384,800. That is the lowest level since March. But, I guess that is not saying much. But with mortgage rates rising, even prospective buyers who are looking to downgrade to a cheaper home would face bigger monthly payments, Shepherdson said. Existing homeowners will be better off financially by staying in the house that they already own. So, this will constrain the supply of houses for sale. But prices have to fall substantially in order to restore equilibrium. The supply curve for housing is not flat, so the plunge in demand will drive prices down, Shepherdson said. We expect a drop of 15 to 20% over the next year, in order to restore the pre-COVID price-to-income ratio, Shepherdson added. Wharton professor Jeremy Siegel basically said much the same thing last week. I expect home prices to see the second worst decline since World War II amid aggressive Fed rate hikes, said Siegel. Home prices are now declining in most markets across the United States. The pronounced rise in mortgage rates over the past several months has basically made housing more expensive for buyers who need a mortgage. There is a sharp turnaround the once red-hot, pandemic-driven housing boom. The pandemic was dominated by a boom in the sale of higher-priced, luxury homes. The number of luxury home sales is falling recently. Certain markets are softening faster or slower than other markets. Markets seeing the largest declines are ones that are the priciest: San Jose, San Francisco, and Seattle. That makes sense because these markets were basically unaffordable to begin with. And with mortgage rates rising, they are becoming even more unaffordable. Among the other markets seeing big declines are the pandemic-fueled boomtowns: Boise, Denver, Salt Lake City, Phoenix, and Las Vegas. People flocked to these comparably more affordable markets when they could work from home. Many tech workers moved from Silicon Valley to the Sunbelt and Mountain West during the pandemic. How far and how much prices will pull back? Well, nobody really knows at this point. U.S. home prices are higher than they were in 2021. But prices seem to be declining every week as sellers get more desperate and buyers back away. Sales of existing homes have fallen in every month in 2022. Sales of previously owned U.S. homes fell for a seventh straight month in August. This is the longest streak of decreases since 2007. Home builder sentiment is in a record collapse. Building permit rates are also declining, an indication that new home building is slowing. Year-over-year sales fell in all 4 major U.S. regions, continued the report. There are still a few areas of the U.S. where demand is still higher than supply. Not all areas of the United States will be equally affected. Rising interest rates have caused homebuilder confidence to tank. Persistent inflation is causing higher costs for labor and materials. Higher costs for land are driving up development costs. So, new home builders are caught in a market squeeze. Redfin CEO Glenn Kelman is predicting the biggest U.S. housing crash since the Great Recession. For the past 5 years, home buyers were typically having to pay over listing price and compete in a bidding war. But now, the average home in the United States is selling for less than its list price. Despite all of the publicity about a housing market crash, home prices are still higher than a year ago. Zillow has sold its portfolio of properties at a substantial discount. Zillow stock is down almost 70% from its 52-week high. The CEO of Redfin has warned that his company is quickly selling off properties in its portfolio. Redfin stock is down over 75% in 2022. But, what do you think? Please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. Please share this video on social media. Thank you for watching.